Let me ask you something. What if the market you thought was pricing silver fairly had almost nothing to do with actual silver? What if the number you see on your screen every day, the silver spot price, was being set not by people who own silver, but by people simply betting on it with paper? And what if that system, which has quietly operated for decades, was finally starting to crack, right now in 2026? That is what this video is about. And by the time we're done, you're going to understand something that very few everyday investors have taken the time to fully think through. So let's start at the beginning, because context matters here. Silver has been in a frustrating range for over 12 years. If you bought silver back in 2011 when it was near $50 an ounce, you've watched it go sideways for a long time. That feels discouraging. But here's the thing. Sometimes a long period of sideways movement isn't a sign of weakness. Sometimes it's the quiet accumulation phase before something significant happens. And the signals we're seeing right now, across multiple data points, suggest we may be entering a moment that silver investors have been waiting a very long time for. Understanding silver's current situation requires understanding two separate things happening at the same time. First, there is a structural problem with how silver is priced, specifically through a system called COMEX, which is the main futures exchange where silver contracts are traded in the United States. Second, there's a new and growing demand story emerging, one that mirrors what happened with Bitcoin when corporate treasuries started adopting it as a reserve asset. When you put these two things together, the picture that forms is genuinely striking, not because it's guaranteed to play out in any particular way, but because the mechanics of what's happening are historically unusual. Let's break this down starting with COMEX, because this is the foundation of everything else. COMEX stands for the Commodity Exchange, and it operates as the primary market where silver futures contracts are bought and sold in the United States. A futures contract is essentially an agreement to buy or sell a specific amount of silver at a specific price on a specific date in the future. Sounds straightforward, right? But here's where it gets interesting. The vast majority of these contracts are never settled with actual physical silver. Most of the time, contracts are simply closed out before the delivery date. Traders take profits or losses in cash, and no real silver ever changes hands. Think about it this way. Imagine you and a friend made a bet on the price of a house. Neither of you owns the house. Neither of you wants to own the house. You just agreed that if the price goes up, he pays you the difference, and if it goes down, you pay him. That is essentially what most silver futures trading looks like. The price is being set by people who have no intention of ever touching physical silver. This creates a pricing mechanism that is heavily influenced by financial speculation rather than by the actual supply and demand of real silver metal. Now here's what makes this relevant right now. Over the past several years, researchers and market analysts who track COMEX data closely have documented something worth serious attention. The ratio of paper silver contracts to the actual physical silver held in COMEX registered vaults has reached historically extreme levels. At various points, estimates suggest that for every ounce of physical silver available for delivery, there are somewhere between 200 to 400 paper ounces representing claims on that silver through futures contracts. Let that number sit with you for a moment. If every holder of a silver futures contract decided at the same time that they actually wanted physical silver instead of a cash settlement, COMEX simply could not fulfill those obligations. There isn't enough physical metal in the vaults. Now, in normal conditions, this isn't a catastrophic problem because the assumption is that most traders won't demand delivery. But assumptions are fragile things. And over the past 2 to 3 years, something has started to shift. More and more holders of COMEX futures contracts have been standing for delivery. Instead of closing their contracts for cash, they're saying, "No, I actually want the silver." This is unusual behavior. It creates pressure on a system that was never really designed to handle it at scale. And when you look at COMEX vault data, registered silver inventories have experienced significant drawdowns during periods of elevated delivery demand. The physical metal is being pulled out of the system, and once physical silver leaves a COMEX vault and enters the hands of someone who intends to hold it, whether that's an institution, a manufacturer, or a private investor. It becomes much less likely to return to the system quickly. Here's what this means for the price. When the paper market is the dominant force setting prices and it isn't constrained by physical supply realities, prices can stay artificially low for a long time. But if the paper pricing mechanism starts to break down, if physical delivery demand keeps rising and vaults keep draining, then at some point the price has to reflect actual physical scarcity. And that transition, when it happens, tends to be sharp and dramatic rather than slow and gradual. This is the first part of the story, but that alone might not be enough to trigger a major repricing. Markets can stay irrational for a very long time. What makes the current moment particularly interesting is the second part, the emergence of a new category of silver buyer that almost nobody was talking about 2 years ago. If you followed the Bitcoin story closely, you probably know what happened when MicroStrategy, now known as Strategy, started purchasing Bitcoin as a Treasury reserve asset in 2020, and then when other corporations followed, and then when ETFs launched. The price of Bitcoin went from speculative curiosity to serious asset class. The reason was simple. A new source of demand appeared from buyers who were purchasing with the intent to hold, not trade. These buyers were not sensitive to short-term price movements the way a trader would be. They were making a long-term reserve decision, and when you introduce structural, non-price sensitive demand into a market with limited supply, the math changes dramatically. Now, something that looks remarkably similar is beginning to happen with silver. In 2026, we started seeing publicly traded companies announce they are purchasing physical silver as part of their corporate treasury. These are not silver mining companies or commodity traders. These are operating businesses choosing to hold silver, physical silver, as a monetary reserve asset on their balance sheets. The logic these companies are articulating is straightforward. Silver is real, scarce, has thousands of growing industrial applications, and has historically preserved value over long periods. In a world where currency debasement concerns are rising and traditional treasury assets offer limited real returns, silver presents a compelling alternative. The companies that have moved in this direction are still small in number, but the pattern is worth paying close attention to because of how it mirrors early institutional Bitcoin adoption. When the first few companies started buying Bitcoin for their treasuries, many people dismissed it as a fringe move. Then more companies followed. Then the ETFs arrived. Each new wave of buyers reduced available supply while increasing visibility, which attracted more buyers, which reduced supply further. It became a self-reinforcing cycle. The question with silver is whether we're at the very beginning of a similar dynamic, and the early evidence suggests we might be. Now let me be clear about something, because responsible analysis requires balance. The comparison between silver and Bitcoin is imperfect in several ways. Bitcoin has a fixed, mathematically guaranteed supply cap. Silver does not. More can be mined, and production does respond to higher prices over time. Also, Bitcoin benefited from its digital nature. It could be held and transferred without physical infrastructure in a way silver cannot. Silver is heavy. It requires storage. It has logistical realities that digital assets don't. But silver also has something Bitcoin doesn't: genuine industrial demand. About 50 to 60% of annual silver demand comes from industrial applications: solar energy, electric vehicles, electronics, medical technology, water purification, and more. And that demand is growing, not shrinking. The green energy transition is silver-intensive in ways most people haven't fully absorbed. A single solar panel uses a meaningful amount of silver. Electric vehicles use more silver than traditional combustion engine vehicles. And global solar installation targets across the United States, Europe, China, and India call for dramatic acceleration over the next decade. That industrial floor under demand is a support mechanism that pure speculative assets simply don't have. So let's put this together into a clear mental framework, because I want you to walk away understanding this coherently. Here is the situation as it stands today. Silver's price has been suppressed for 12 years, relative to where many analysts believe its fundamentals would place it if pricing were based on physical supply and demand. The COMEX paper futures mechanism has become increasingly strained as physical delivery demands rise and vault inventories draw down. Industrial demand for silver is growing, driven primarily by the energy transition, and now, for the first time, a small but growing number of corporations are treating silver as a Treasury reserve asset, rather than just a commodity. Each of these factors on its own would be interesting. Together, they form a structural argument for a potential major repricing unlike anything we've seen in silver for at least a generation. The $300 price figure discussed in some analytical circles isn't a random number. It reflects historical gold-to-silver ratios, industrial supply deficit projections, and comparable asset repricing events. Throughout most of recorded monetary history, the gold-to-silver ratio hovered between 10 and 20, meaning an ounce of gold bought 10 to 20 ounces of silver. Today, that ratio sits around 80 to 90. If silver were to return to even a historically moderate ratio relative to gold, and if gold continues making new highs as it has in 2026, then silver at dramatically higher prices becomes mathematically plausible without requiring wild speculation. And right here is a good moment to pause. If you're finding this analysis useful and you want to keep getting this kind of research-driven content that digs into real market structures, please take a second and hit subscribe. And if this video is making you think, drop a like. It genuinely helps this channel reach more people trying to understand what's happening in financial markets. Now let's talk about the risks, because they are real and you deserve to hear them clearly. The biggest risk to the silver repricing thesis is timing. Markets can stay dislocated from fundamentals far longer than any analyst predicts. Silver has frustrated believers for 12 years already. It could frustrate them for another 5 or 10. The COMEX system, despite its structural strains, has proven remarkably resilient. Large financial institutions have strong incentives to maintain the status quo because a sudden silver repricing would create enormous disruptions across derivative markets. They will resist that disruption, and they have tools to do so. There's also the mining supply response. If silver prices were to rise dramatically, it would incentivize significantly more mining production. Silver is mined both as a primary target and as a byproduct of copper, lead, and zinc mining. Higher prices would bring more supply to market over time. This is how commodity markets work. Even if a major repricing occurs, the ceiling is not unlimited. And there's regulatory risk. If governments decided that silver was becoming a vehicle for financial disruption, or if they moved to regulate corporate Treasury silver purchases in some way, that could dampen the corporate adoption story significantly. History shows that governments have sometimes responded aggressively to assets that challenged monetary order. So what's the balanced takeaway? The structural case for silver's repricing is more compelling today than at any point in the last decade, possibly longer. The convergence of a strained paper pricing mechanism, growing physical delivery demands, accelerating industrial consumption driven by the energy transition, and emerging corporate Treasury adoption creates conditions that historically precede major asset repricing events. But the timing of such a repricing is genuinely unknown, and the obstacles to it happening quickly are real. There's also one more dimension worth connecting. The artificial intelligence infrastructure build-out currently underway, massive investment in data centers, semiconductor fabrication, and advanced electronics, all of this requires significant amounts of silver. Silver is the most electrically conductive metal on Earth. It's used in semiconductors, circuit boards, connectors, and high-performance electronic components that become more critical as the AI economy grows. So in a somewhat striking twist, the same technological revolution many people use to analyze financial markets may itself be creating additional physical demand for one of the oldest monetary metals in human history. Solar panels, electric vehicles, and AI infrastructure, three of the defining technological trends of our time, all have meaningful silver intensity built in. Here is the simple framework I'd leave you with. Think of silver as sitting at the intersection of three demand categories, each growing: industrial and technological demand, driven by solar, EVs, and AI infrastructure; monetary demand, driven by hard asset interest and the emerging corporate Treasury trend; and investment demand from everyday investors seeking alternatives in a complex market environment. Now set against that a supply picture where global mining production has been relatively flat for a decade. Major new discoveries are becoming rarer, and the paper market mechanism that has historically suppressed the price signal is showing genuine structural strain. When multiple growing demand categories converge against constrained supply with a weakening price suppression mechanism, that is an environment where the conditions for significant repricing exist. Does that guarantee silver goes to $300? No. Nobody can guarantee any price target for any asset. What I can say is that the structural argument for silver being significantly mispriced relative to its fundamentals is stronger today than it has been in a very long time. And the emergence of corporate Treasury, buying as a new demand category, structural and non-cyclical rather than speculative, is a genuinely new development that changes the demand equation in a meaningful way. The history of major asset repricing events, whether it's oil in the 1970s, gold in the 2000s, or Bitcoin in the 2010s, is that they are almost never obvious to the majority of people while they're building. They become obvious in retrospect after the move has already happened. The structural signals in silver right now are the kind that, looking back in 5 or 10 years, people may point to as the moment the setup became clear. I'm not here to tell you what to do with your money. That is sincerely not my place, and any content creator who tells you exactly what to buy and when should be approached with serious caution. What I am here to do is help you understand the dynamics at play, give you a framework for thinking about them, and point you toward the questions you should be asking. From there, the decisions are yours, informed by your own financial situation, your own risk tolerance, and ideally in conversation with a financial professional who understands your circumstances. What I hope this video has done is taken you from seeing silver as simply a commodity with a frustrating price chart and helped you see it as something with a layered structural story evolving in real time. The 12 years of sideways movement that frustrated silver investors is not necessarily evidence that the thesis is wrong. In many historical cases, extended periods of price suppression followed by structural breakdowns produce the most dramatic repricing events. Whether silver follows that path remains to be seen, but understanding why it might and the mechanisms that could make it happen puts you in a much stronger position to think clearly about it, regardless of what the price does in the short term. This is John Smith, and if you want to keep getting market analysis that digs into the deeper structural forces shaping financial markets, make sure you're subscribed to this channel. We cover monetary economics, market structures, and long-term financial trends in a way that's designed for real people, not just Wall Street insiders. Leave a comment below and let me know what you think about the silver thesis, whether you're a believer, a skeptic, or somewhere in between. Until next time, stay curious, stay patient, and take care of your financial future.